When we talk about different frameworks to try to describe the economy, we talk a lot about the K-shaped economy, the consumers on the top and the bottom. Now adding to the mix the A Pillars Foundation. Lay it out for us in your own words.
Yeah, I think there's been a lot of talk around the K-shaped consumer spending outlook, but it's broader than that. The economy is K-shaped. We're seeing greater degree of polarization in terms of the different drivers of economic activity. And what I wanted to reflect with the 3 A pillars was essentially that we have a narrow foundation to economic activity, which is currently going through a virtuous cycle because all of these pillars are interconnected, but there are downside risks if any one of these pillars starts breaking apart. The idea is that essentially we have optimism around AI. We're seeing a lot of capital investment that is supporting economic activity. About a third of GDP growth in the first half of this year was driven by AI investment. Wow. Data centers, investment in semiconductors, software, R&D, all driving economic activity, which is very good. There's been also a lot of optimism in terms of the stock market that has been driving up valuations, but it's been a K-shaped outlook when it comes to the stock market. Not all firms are created equal in this environment. There's some investment that is just out of the fear of missing out here. And then that is in turn supporting a greater wealth effect, which is gradually supporting more spending by more affluent consumers. The less affluent consumers are less invested in the stock market. They're not benefiting as much from that. This is all very good, but if there starts to be doubts around the prospects for AI, if there starts to be a bit of a pullback in investment or pullback in some of the big names on the AI front, what effect does that have in terms of the wealth effect, the confidence effect, even for those that aren't invested in the stock market? It could actually lead to a pullback in consumer spending activity.
That's a lot of questions, right, of ifs in terms of how it plays out. I think of foundations, Greg, and there are different types of foundations, and some can withstand a lot, some cannot. How strong is the foundation, in your view, of this AI spend, which has led to higher asset prices on all things connected AI, and then ultimately, leads to those asset price gains and people spending, especially among the wealthy, who are mostly in the market or some other kinds of investments?
I think one of the things that we talk to a lot of clients about is this notion that we are increasingly in an environment that is driven by supply-side dynamics. It's a very different economic environment, a very different economic paradigm than what we've been accustomed to for the past few decades. And when I say that, people start to perk up and ask, what do you mean by that? Right. And what I mean by that is that over the past few years, we were accustomed to an environment where demand-side dynamics drove economic activity. Now it's all about supply shocks. It's trade and tariff policy. It's immigration and demographics. It's climate change and weather disruptions. It's the AI revolution that is lifting supply. And the reason why that matters is because those supply shocks have counter-cyclical effects on output and inflation. On the one hand, they tend to lift output and reduce inflationary pressures if it's a positive supply shock. Right. But if it's a negative supply shock, it does exactly the opposite. It reduces your potential supply and increases inflation, which is stagflationary.
We talk about that with energy and power and the AI draw and higher electricity prices.
Greg, does it feel like to you that since you coined this framework, the foundation when it comes to artificial intelligence fueled investment has become more questionable? Has that, if you think about it like 3 legs of a stool, is that stool getting weaker?
It's not getting weaker, but it is an environment where there are certain doubts as to how much of the investment is viable, is actually productive. There are 2 strands of investments when it comes to AI. There is essentially the foundational aspect, developing the infrastructure, developing the software, developing the cybersecurity element, developing the data centers. All of that is real investment driven towards supporting this technological revolution. There is also corporate adoption. Right? A lot of firms want to be ahead of the curve. A lot of questions that we get are we behind the curve? Should we be investing more? And the fear that I have is that sometimes this FOMO sentiment leads to inadequate capital allocation, where essentially we're just spending money on AI, but what's the real end use? What's the productivity gain down the line?